Welcome to Data Science Trading. In today's video, we're going to dive into one of the most popular technical indicators for traders, the Relative Strength Index, or RSI. Whether you're a beginner or experienced trader, understanding RSI can help you make better informed decisions in the market. Stick around as we cover what RSI is, how it's calculated, and most importantly, how to use it in your trading strategy. RSI stands for Relative Strength Index, a momentum indicator that measures the speed and change of price movements. It was developed by J. Welswilder in 1978, and it ranges from 0 to 100. Traders primarily use it to identify overbought or oversold conditions in a market. The general rule of thumb is that when the RSI goes above 70, it indicates that the market might be overbought, and when it goes below 30, the market could be oversold. Let's briefly touch on how RSI is calculated. RSI is computed using the following formula, where RS stands for the relative strength, which is the average gain of N periods divided by the average loss of N periods. Typically, traders use 14 periods for RSI, meaning the average gain and loss are calculated over the last 14 candles or time intervals. Once the RS is determined, it is plugged into the RSI formula to give a value between 0 and 100. Now that we know what RSI is and how it's calculated, let's discuss how to interpret the RSI indicator in practice. As mentioned earlier, a value above 70 suggests overbought conditions, and below 30 indicates oversold conditions. But what does this mean for you as a trader? Overbought doesn't necessarily mean it's time to sell right away, and oversold doesn't always mean you should buy. It's more of a warning that the asset is getting into extreme territory and a reversal could be coming soon. For example, if the RSI crosses above 70, it's a signal to start paying attention and possibly prepare to take profits. If it crosses below 30, it may indicate a buying opportunity as the asset could be due for a bounce. Now let's talk about how you can use RSI in your trading strategies. The two most common strategies are RSI divergence and RSI overbought or oversold zones. RSI divergence. This occurs when the price of an asset is moving in one direction, but the RSI is moving in the opposite direction. For example, if the price makes a higher high but the RSI makes a lower high, it could be a sign that momentum is weakening and a reversal is likely. Overbought or oversold zones. Many traders use RSI as an entry or exit signal when it crosses into overbought or oversold territory. For instance, when RSI goes above 70 and starts moving back down, traders might see this as a potential signal to sell. Similarly, when it dips below 30 and begins to rise, traders might see this as a buying opportunity. RSI is a powerful tool, but like any indicator, it has its limitations. One of the biggest mistakes traders make is assuming that RSI will always lead to a reversal as soon as it hits overbought or oversold levels. Sometimes, the price can stay in these zones for extended periods during strong trends. This is known as the RSI trap. For example, in a strong uptrend, RSI might hover above 70 for a long time, and selling too early based on that signal might lead to missed opportunities. So always remember to combine RSI with other indicators like moving averages, support and resistance, or candlestick patterns for better accuracy. To wrap things up, RSI is a simple but effective indicator that can help you spot potential turning points in the market. It's best used in combination with other tools to confirm signals. Make sure to practice using it on a demo account before applying it to live trades. Stay tuned for RSI Python back-tested result in upcoming video. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell to stay updated with more trading strategies and tips. Drop a comment below with your favorite RSI strategy or any questions you have. I'd love to hear from you.